Most people think building wealth is about how much they earn or what they invest in. While yes, that's important, it's not the ultimate thing. The biggest mistake people can make with their personal finances boils down to not paying attention to all the right areas. And I would say the most obvious one I see is when it comes to choosing the accounts they put money into. Somebody can get so caught up focusing on what to invest in when really their issue is something much simpler and much more impactful. It's the account wrapper around those investments, because two people can buy the exact same index fund or investment for that matter with completely different outcomes 30 years from now, just because one of them ended up using the account that fit their long-term plan and the other just followed a rule of thumb guidance. Tax laws change, family dynamics change, income changes, employee benefits change, and if you're not spending enough time thinking about where your money is sitting, those blind spots become inevitable throughout the year. I'm Devin Watts with Fallbrook FI, and in this video, I'm going to walk through 8 accounts that, when used strategically, can genuinely add 7 figures to your net worth over time. And those accounts are the 401k, the taxable brokerage, the Roth IRA, the traditional IRA, a UTMA, a 529, a donor advised fund, and the HSA. Let's get into it. Almost everyone has heard of a 401k. Now, for this video, this is synonymous to a 403b or TSP, and for all intents and purposes, we can lump in a 457b and 401a plans as well. And the mistake is usually not that they are ignoring this type of account, it's that they're missing opportunities within. For 2026, you can contribute up to $24,500 as an employee to this account. However, the total contribution room between you and your employer is north of $70,000 a year. I covered this dynamic in another video on my channel that you can find in the description below. Now, something else that's overlooked is if you've switched jobs and have an old 401k or 403b, these old plans are likely costing you in the form of fees. Old 401ks and 403b plans, or even 457 and other types of plans out there, will pass along these admin costs to you, and you're left paying fees that you don't know whether it's worth that fee. Easiest resolve here is to download the most recent monthly statement or quarterly statement and look at whether they're charging you fees. The second thing is deciding between traditional pre-tax contributions and Roth 401k contributions. Pre-tax lowers your taxable income today. Roth means you pay taxes now and you get to pull the money in retirement completely tax-free. Now, income changes, tax brackets change, and the right answer really depends on where somebody expects to be in their career and when they expect to use these dollars. That is not a decision to make on autopilot each year. Now, the Roth IRA. This is one of the most misunderstood accounts. People either think they earn too much to use it, or they overlook it entirely because the contribution limits feel small. Both, I would say, are mistakes. In 2026, the limit is $7,500 per person. And if you're over 50, that contribution limit jumps up to $8,600. The income phase out for joint filers starts at $242,000 and cuts off at $252,000 in 2026. So yes, high earners phase out, but that does not mean the Roth IRA is completely off the table. It means they need to know about the Backdoor Roth strategy, where you contribute to a traditional IRA and then convert it to the Roth. However, what makes the Roth so valuable is the combination of tax-free growth and no required minimum distributions during the owner's lifetime. Somebody who maxes a Roth IRA consistently from their 30s until retirement is building an account the IRS essentially cannot touch. That is a powerful thing to have in the back half of a financial plan. Bonus points here for the Roth IRA is a Roth IRA for minors. This can be a great opportunity for business owners with kids that can do some work for their parents' business. Once the minor has earned income when they're working for the parents' business, you can fund the Roth IRA contribution for the year in which they had earned income up to either the contribution limit or up to the amount that they earned in that year. Now, the traditional IRA, account number 3, it's sometimes overlooked because it shares the same contribution limit as the Roth, but it serves a different purpose, and for certain situations, it is the right tool. Contributions may be tax deductible depending on your income and whether you have access to a workplace retirement plan. If something is deductible, they get a similar tax break as a 401k, and even if they are not not tax deductible. The traditional IRA is still the vehicle that makes the backdoor Roth conversion possible. Where a traditional IRA typically comes into the picture for most retirees is in the form of what's more technically known as a rollover IRA. It's a pre-tax IRA that allows you to consolidate your 401k, 403b, or other pre-tax retirement accounts. This typically shows up once an individual has retired, and rolling over the accounts makes sense. This opens the door for things like 72T distributions, and most importantly, I would say it's way easier to pull money from an IRA than from a 401k plan. The other thing worth noting is that with a traditional IRA, it enforces, or the IRS enforces, what's called required minimum distributions, and those typically start at age 75. That means the government will eventually require withdrawals whether someone needs the money or not. So the traditional IRA is really a planning tool. You want to know about how much pre-tax money accumulates there and whether future Roth conversions make sense before those RMDs kick in. Now, account number 4. It's a taxable brokerage account, and it's not glamorous. There's no upfront tax deductions, no tax-free growth, but flexibility is exactly the point, and flexibility has a significant value here. Unlike retirement accounts, a taxable brokerage account has no contribution limits, no income restrictions, no penalties for early withdrawals, and no required minimum distributions. Somebody who wants to retire at 50 or just wants to have access to money before age 59 and a half without penalties, they really need this account. And real quick, if you like this type of content, subscribe to Fallbrook FI for more videos like this. Now back to the taxable account. The tax treatment is also better with this account. Long-term capital gains, meaning gains on the investments held longer for 1 year, are taxed at significant lower rates. So capital gains are taxed at a much lower rate than ordinary income for most people. And when assets are passed to heirs, when the account owner passes away, the cost basis gets stepped up to the value at the date of death, which can eliminate a significant capital gains tax bill entirely. Somebody can get caught up thinking the taxable brokerage is less important because it does not come with the tax perks of a 401k or a Roth, when really, for the right situation, it's the most powerful account in your tool belt. Now let's look at account 5 and 6, meant to pass on wealth to the next generation. I briefly mentioned the Roth IRA for a minor, but these two accounts are both built around transferring money to children or grandchildren. They work very differently and serve different goals, but neither of these require your child to have earned income. The 529 account, the first one that we'll talk about, is ideally just meant for education. Contributions grow tax deferred and come out completely tax-free when used for qualified education expenses. There are some certain use cases where you can still use it, not for qualified expenses, but use it tax-free and penalty-free. But to begin with, the tax side of it, about 40 states also offer a state income tax deduction or tax credit for the contributions. The contribution side, the annual gift tax and that exclusion amount per year is where the contribution limit comes in. So for 2026, that's $19,000 per donor. So per parent or per grandparent can donate that amount per beneficiary or per 529 account for that child or grandchild each year. 529 account also allows what's called super funding, which you can front load the contributions. So for 2026, that's $95,000 per beneficiary, and treat that as the 5-year gift or contribution as one annual gift. The next account here, the UTMA or UGMA account. I would consider this a custodial account. There's no contribution limits to this type of account, and the use cases are not really restricted because the money either has to be used for the benefit of the child or the child gets complete access to this account, typically at age 18 or 21, just depends on the state of which the child and the account are created in. The trade-off is that the assets legally transfer to that child and have to be used for the benefit prior to the age of majority for that child. So age 18 is usually the age of majority. So there is less long-term control over the account from a parent's perspective, but a lot more flexibility on the use cases for that type of account. There's also the tax benefit. Investment earnings in a UTMA, UGMA, or custodial account are subject to what's called the kiddie tax rule, where income above a threshold gets taxed at a parent's tax rate. However, Tax gain harvesting is a major opportunity in this account where the child gets to pay a 0% taxes on capital gains. That's really important to look into. So I would say the 529 account is better for education planning with real tax advantages, but the UTMA or UGMA or custodial account, it's better for broader wealth transfer where flexibility matters more than tax efficiency. Understanding though which one to use and when to use both is the decision that most people don't spend enough time thinking through for their family. Now on to the HSA. This account has some strings attached and a health insurance hurdle that causes most people to forego the account to begin with. I would say if the high deductible health insurance plan is not suitable for your family, the HSA is not worth the health care costs that causes potentially some stress within your family. But generally speaking, if you're healthy and you have low medical needs, the high deductible health plan with an HSA really needs to be considered. Why? Because it's got a triple tax advantage, meaning contributions, when they go in, they're pre-tax. The money in that account can grow tax-free, and withdrawals for qualified medical expenses are, on the federal side, completely tax-free. Now, no other account does all three of those things. For 2026, you can, as an individual, contribute $4,400 to this account. This doesn't include your employer contributions, so that gets reduced. $4,400 minus your employer contributions is how much you can fund the HSA for 2026. Same thing for your family coverage, up to $8,750 in 2026. And if you're over age 55, you can add another $1,000 on top of that. But here's the part most people will miss. Once your HSA balance exceeds a certain threshold, typically around $1,000 or $2,000, depending on your provider and your employer, you can invest those funds just like an IRA or a 401k, and the money has tax-free growth opportunities. After age 65, you can withdraw any money from that account for any reason, not just medical expenses. Non-medical expense withdrawals from that account after age 65 just get taxed as ordinary income at that point. It's exactly the same as a traditional IRA after age 65. Somebody focused too much on using HSA funds to cover every doctor visit is missing the bigger picture. The real benefit and the real strategy is to pay medical expenses out of pocket while you're working. Let the HSA and the investments in that account compound for decades and come out the other side with a tax-advantaged account that covers healthcare in retirement tax-free. Lastly, the Donor Advised Fund, or DAF, or also known as DAF. It's built for people who are wanting to give to charity and want to do it in a way that makes financial sense. When somebody itemizes their deductions on their tax return and they contribute to a donor advised fund, they get a deduction up to 30% of their AGI for non-cash gifts like stocks, or 60% of their AGI for cash contributions. The money in this account can grow and remain invested, and that growth is tax-free once it's inside the donor advised fund. And even better, the donor can recommend grants to a specific charity over time on their own schedule. The big opportunity here is timing. Somebody who earns a large bonus one year, or has a good year harvesting their farm, or plans to sell a business, or has an investment with a significant capital gain attached to it, they can make a large lump sum contribution to the donor advised fund in that high income year and capture a huge tax deduction. For the non-cash assets, you'd want to donate those directly to the donor advised fund in order to avoid the capital gains for selling the investments. Instead, you'd want to sell that asset or the investment once the investments are inside the donor advised fund. Then you get to recommend the actual charitable giving portion according to your preferences. Now, it's important to note, tax laws do change. In 2026, some adjustments to charitable deduction rules are taking effect. So this is genuinely an area where getting advice before acting really matters. But the core structure of the donor advised fund remains one of the most tax efficient ways to be giving. And most people with charitable intentions are not using it. Now, the real point of all of this is not to tell somebody they need all 8 of these accounts at once. The point is to understand how they fit together, because the combination is where the real advantage is. Consider this hypothetical scenario. Somebody is 35 years old, 2 kids under the age of 10, earning $400,000 a year and only using their 401k. They are contributing, the money is growing, but they have blind spots. They have no Roth IRA or Backdoor Roth to build tax-free income for retirement, no HSA accumulating decades of tax-free medical payments, no 529 account for the kids, no taxable brokerage account for flexibility beyond retirement age, and likely no donor advised fund to handle charitable giving efficiently and effectively if and when their income spikes. Now, take that same person at 65, compare them to somebody who layered all of these accounts intentionally across 30 years. That gap is not marginal. It's genuinely measured in hundreds of thousands of dollars, sometimes more, just paying attention to all of the right areas. Tax laws change, contribution limits change, family dynamics change, income changes, employee benefits change, and if this mix of accounts makes sense at 35, it doesn't mean that it makes sense also at 45 or 55. This is why the decision is not a one-time choice. It requires ongoing attention. Let me know in the comments below, what accounts are you focusing on right now? Also, what accounts are you most confused by? I'd love to make more videos about these accounts and the use cases for these accounts so that you can be better equipped to handle your finances and be confident about your financial future. And if you're looking to talk to someone who helps organize and strategize around all of this, book a call with me using the link in the description below.